I'm not buying it. Royal LePage, and that's the company I work for, is saying home prices in Canada are going to increase in the back half of 2024. Hey there, and welcome back to Bald Prairie Real Estate. My name is Matthew Pfeifer, real estate agent in Regina. That's my trusted assistant, Matilda. This is the weekly news recap here on Bald Prairie Real Estate. I go through the most interesting Canadian real estate related news topics, give my thoughts and opinions on them. And boy, have I got an opinion on this Royal LePage forecast that home prices are going up. Let's give you a little teaser. I'm not so sure on that, but I've got a double feature of news this week because I was going to be talking about a couple of these topics in this week's news recap last week, but due to some technical difficulties, mainly me not filming this in focus correctly, that video couldn't come out last week, so we'll be talking about it this week. But let's start off with a terrible joke and get you into this week's news. What is a chiropractor's favorite type of music? Hip hop. If you have a terrible joke I can use in the future episode, put it in the comments below. Let's get into this week's Canadian real estate news. Let's start off by talking about 40-year amortizations and should homeowners be allowed to do that. So I thought this was an interesting idea, and that is that when a homeowner is renewing their mortgage, they could extend that amortization back out to 40 years, which is not available in Canada right now. You can only do 25 years or 30 years depending on down payment. But they could extend that back out on renewal to reduce payment shock. Of course, many homeowners are going to be going through that over the next couple of years, going from sub 2% mortgages to probably 4.5% to 6%, depending what rates are available in the coming year or so here. So if they extended that out, that would of course reduce their payments monthly, but it also would mean they pay significantly more in the long run. A goal should always be to pay your house off as quick as possible when it comes to primary residence. That's just a personal opinion of mine. The longer you have to pay that off, the more it's going to cost you in interest. And I know a lot of people have been talking about how people already have these extended amortizations, and that's not correct at all, because there's a very big difference between effective amortization and your contract amortization. So when people talk about these 40, 50, 60, 70-year mortgages, that's effective amortization. That is when you have those fixed payment variable rate mortgages, and as interest rates have gone up, that has meant more and more of their payment is going to interest, and eventually all of it's going to interest, and in some cases even more. So that is meaning effectively they're paying down none of their house and there's debt being added to that mortgage, not being reduced. So the effective amortization increases. But when they come up for renewal, they have to get back in line with whatever their contractual obligation was. So if it was a 25-year mortgage, they have to get it back up, meaning they're gonna have to pay a lump sum payment to get caught back. And of course, those payments are going to increase. We've seen those effective amortization, those really long amortization mortgages has continued to decline over the last year. People are catching up, but banks are forcing them to do so. So again, we haven't really talked about this much, but that was a headline, 6 months, a year ago, that was a really big topic, not so much anymore. It also works in reverse when the Bank of Canada starts reducing rates as well. So as the Bank of Canada starts reducing rates, which it looks like they're going to continue to do here, that's also going to reduce those effective amortizations back down to where they should be. But the theory in this article is that homeowners should have the ability to choose to actually extend back out that amortization contractually when they come up for renewal to again reduce that payment shock. I'm curious what you guys think. Should this something be allowed where a homeowner, they've been up in good standing for their mortgage? This would be, I assume, only for those that are in good standing on their mortgages, could extend it back out to reduce those payments if they wanted. Could, of course, again, potentially shorten it as well as they caught back up or as interest rates come down. But you guys let me know in the comments below. Should homeowners be allowed to extend out amortizations to reduce the payment shock on renewal? Real quick pause here. If you're thinking about buying a house in Regina, obviously I'd love to help you out. But if you're somewhere else in Canada, don't worry, I can get you set up with a perfect real estate agent that'll handpick for you. If you check out the description of this video, you're going to see a link to my calendar where you can book me in for an agent recommendation consultation. I'll give you a call, learn about what's important to you in a house, in a real estate agent, and I'll get you set up with that perfect agent in your market. And now let's get back to the video. Now let's talk about homeowners being forced to sell their homes because of financial stress. I thought this was a really interesting article because they surveyed homeowners and said, okay, if you have to sell, what are the reasons as to why you're selling? Now, this is a survey they could answer multiple questions. So when you add them all up, it doesn't get to 100%. I think it's 131% or something. You add them all up. But your top 3 answers are your usual suspects. They're moving because of relocation, they're selling because of relocation, they're upsizing, or they're downsizing. Those are all very typical reasons. Only 11% cited in this survey that they had financial stress as the reason they were selling their home. Now, I expect this is going to increase as we have more and more renewals coming up with higher interest rates. That's especially going to be becoming more apparent in the back half of this year into 2025 and into 2026 as all those 2020 and 2021 renewals start coming up. But again, most homeowners at this point right now, at least according to this survey, are not having significant financial stress, which has caused them to sell their house. And we're seeing that still reflected in those delinquency rates, which have stayed really low. I mean, they continue to creep up, and I expect they will continue to creep up, but they're really only at about 0.19%, which is well below that pre-pandemic level of about 0.3, 0.35%. So we're still not seeing that really negative impact of higher interest rates that a lot of people are predicting, where homeowners would get behind on their payments and have to sell their house because of financial stress, or they would be foreclosed on by the banks, and we'd see this big wave of properties being put up for sale because of that. We're talking on my monthly market update though, we are absolutely seeing a lot of condos hitting the Toronto real estate market right now. Next up, we've got a Point2 Homes renter to homeowner survey. This article I thought was really interesting because they break it down by different age demographics, the buying intentions of current renters looking to become homeowners. Starting off with Gen Z, 72% of them would like to buy a home, and they had already, many of them already saved up $30,000 for down payment. Now, I get it, in a lot of markets in Canada, that isn't going to get you anywhere. But on the flip side, in a significant number of markets in Canada, that's at least a 5% down payment, in some cases a 10% down payment on a fairly nice starter home. Regina, Saskatchewan, those are two markets, Winnipeg as well, Edmonton, those types, that's going to get you a down payment on a fairly nice starter home. Looking at younger millennials, 57% of them wanted to still buy a home, and they'd saved up $50,000. Again, Toronto, Vancouver, that's not going to get you anywhere, but on a lot of other markets, that's going to get you pretty close to that down payment requirement. Older millennials, this one is interesting because their biggest concern was worried about the down payment. About 35% of them were worried about down payment. Of course, home prices, 34% were worried about how high they were, but still 50% of them looking to buy a home. Another little interesting nugget of information in this article is that 42% of current renters were looking to apply for a mortgage by themselves, not with a partner. So I thought that was very interesting. When I'm working with first-time home buyers, almost always these young buyers are buying it together as a young couple. Not very often do I deal with just an individual buying a house. So this was interesting that they're looking to apply for a mortgage by themselves, knowing though that their income and their down payment still might not be enough to get them to that home ownership dream. So just really interesting, some things here. Again, I'll leave this article in the description below so you can check it out yourself. Let's do a quick dive into what's going on with mortgage rates now, because sometimes it doesn't really make a lot of sense. I want to do a super quick explainer of what drives mortgage rates. If you're a regular viewer, you already know this, but if you're a new viewer, let's quickly talk about it. If you have a fixed interest rate, that is going to be determined by what happens in the bond market, and most specifically, the Canada 5-year bond. When that increases, the interest rates for fixed rates will also increase. And typically, the banks look for about 1 to 1.5% spread on whatever that is. So for example, the recording of this video, it's been hovering around that 3.5% range, meaning that you should expect to see interest rates at around 4.5 to 5%. But we're not seeing that just yet. I have been talking with mortgage brokers, and they said they were seeing some stuff, 4.99, 4.89, and some stuff just over 5%. If you have a variable rate mortgage or a variable rate fixed payment mortgage, that is determined by the Bank of Canada. So when the Bank of Canada dropped rates, anybody who's on a floating variable saw that monthly payment come down. If you're on one of those fixed payment variables, the portion of the payment that is interest would have decreased a little bit. And so we've talked about this many times before, those effective amortizations that increased way out 50, 60, 70 years, crazy numbers like that. Well, because the Bank of Canada dropped that rate, that will actually also reduce those effective amortizations as well with it, although it's going to be very slightly. In my predictions video for the 2024 Canadian real estate market, I said I think at some point in the year, we're going to see interest rates for mortgages around 4.5%. Now, we're not there yet, but if the bond rate continues to stay at that 3.5 or even drops a little bit, the chances that are going to increase significantly. Now, a couple of things I found really interesting, just when I read through my comment section, on Twitter, etc., is that there was a lot of people that talked about how when interest rates go up, for every percent that interest rates go up, house prices go down. And all of a sudden now that we're seeing, Bank Canada drop interest rates and those 5-year starting to drop a little bit, for some reason those same rules don't apply. And then of course, how many people said in my comment section, well, it takes 12 to 18 months for interest rates to impact the market. Those are also the very same people that as soon as the Bank Canada dropped interest rates and we didn't see prices go through the moon are saying, well, why didn't prices go through the moon? Interest rates dropped. Again, takes time for these things to happen, but there's no set fast rules where it's 12 to 18 months because there's so many other factors that play into house prices in Canada. It's not just interest rates. They absolutely have a significant impact, but that's not the only factor. Rentals.ca is out with their July 2024 rent report. Let's take a quick look. Between CMHC and Rentals.ca, I typically talk about the Rentals.ca rent report just because I think they do a really good job, but CMHC does as well, but they kind of have an SL format for Rentals.ca. The average rent, they kind of add this all up together, almost $2,200 a month in Canada. It's up 7% year over year, but interestingly, that's the slowest rate of growth in 13 months. Many months I've been talking about 10+% a year, and we are seeing it slow down. This is especially true in the larger markets like Toronto and Vancouver, where it's actually been decreasing, and in some cases by some fairly significant numbers. Now, again, part of this is seasonal. Once we get to this part of the year, much like with home prices, typically rent prices start to trail off as well. So you'll see them continue to trend down most likely through the back half of the year. And then when you hit that December, January, February type frame, that's usually when rent prices drop out. Same thing is true in home prices as well. Interestingly enough, it's the smaller, more affordable markets that are seeing some of the largest increases. For example, my market, 1-bedroom apartments went up 20% year over year. 2 bedrooms are up about 15%. Same thing true in Saskatoon, in Winnipeg, Edmonton, Calgary, all of those cities that are more affordable cities when it comes to rent and also purchase prices are seeing some of the largest year over year rent increases. And the same is true on home prices. All of those cities pretty much are seeing year over year home price increases as well. Royal LePage is out with its newest updated Canadian housing market forecast, and they're saying home prices are still going to go up in 2024. The headline for this post right on the Royal LePage website is the spring market that never was. And then they go on to say that home prices are going to increase 9% year over year. So comparing where we're going to end the year in 2024 versus where we ended the year in 2023. I'm just not seeing how this is a likely scenario. I talked about it in my 2024 forecast video that I thought the most likely scenario is we ended the year relatively close to where we start the year. We'll see that seasonality where prices will increase in the spring and then fall off in the back half of the year. I just think the most likely scenario still is that home prices end, within 2, 3, 4, 5% up or 2, 3, 4, 5% down, somewhere in that range nationally. So Royal LePage right now, if you look at the aggregate price, is about $735,000 nationally. We ended 2023 in that low $700,000 range. So if prices just remain flat and did nothing for the balance of the year, and that's not what's going to happen, we would end the year with home prices up, about 5%. So Royal LePage, for this forecast to come true or to be accurate, needs home prices to actually increase in the back half of the year. And I'm just not seeing that being a likely scenario. Now, why they're saying this is going to happen is they're still expecting more buyer activity with the Bank of Canada dropping interest rates. Now, I've said before in other videos that 25 or 50 basis points has really no material impact on the market, buyer qualification, etc. It does change buyer sentiment, but I just don't think, a couple of cuts is going to be enough to make a meaningful difference, especially to see national home prices, have to go up 2 to 5% to get to that 9% spread that Royal LePage is expecting. And the data from Royal LePage's own survey kind of backs this up. It was really interesting. They did this a couple of months ago. They surveyed people that want to buy a home and asked them, okay, if the Bank of Canada starts dropping rates or fixed rates start dropping, how much do they have to drop to get you off the fence and back into the buyer's market? And so the study had said that 10%, so they would jump back in the market if interest rates drop 25 basis points. 18 said they would get back in the market if they dropped 50 to 100 basis points. And 23% said it would take 100 basis points or more than 100 basis points to get them back into the market. So unless we see more than 100 basis points of cuts. And I actually think we're going to get there by the end of the year, but they need to have this happen faster to see home prices increase, that 9% at the end of the year. So they're coming at this saying, okay, when interest rates drop, fairly significantly, then we'll get buyers jumping the back in the market. And I agree with that sentiment. I just don't think we're going to get there anywhere near fast enough to see this price increase that we need at the end of the year for Royal LePage's forecast to come true. And Royal LePage has been relatively accurate in the past, but I'm just not thinking they're going to get this one right as of where they're at today. Again, they're probably going to revise this. But you guys, let me know in the comments, where do we end the year, kind of year over year price change, and what type of an interest rate drop would it take if you're thinking about buying a house to get you back into the market? Let me know in the comments below. That wraps up this week's double feature of Canadian real estate news. If you liked the video, please give this video a like. Right here is what the YouTube algorithm says you need to watch next on Bald Prairie Real Estate. Leave some comments below. I love chatting with you guys in that comment section. And as always, thanks very much for watching.